gestation period and capital-intensive nature of operations has constrained ROCE of ICRA's sample set. However, improvement in performance of mature hospitals across players and turnaround of many of the new centers led to sharp improvement in ROCE during FY 2022. ICRA expects ROCE to moderate in the next 2 years due to new capacities coming on board, which typically require 5 years to break even at the EBITDA level for a multi-specialty hospital. While COVID-related uncertainties resulted in deferment of organic capex of industry players over the last 2 years, several players have announced sizable expansion and upgradation and refurbishment plans for the next 3 to 4 years. Hospital players in ICRA's sample set have added approximately 360 beds in H1 FY 2023, and we expect another 750 to 850 beds to be added in H2 FY 2023 and more than 1,000 beds to be added in FY 2024. Further, some large players in the sector continue to scout for inorganic growth opportunities. This slide provides a snapshot of capacity additions being undertaken by industry players across key regions. Various hospitals have announced significant bed additions in metros as well as Tier 1 and Tier 2 cities. This is phased out over the next few years. However, most of the capacities are expected to be set up in metro cities. Some of the large players are also entering into operations and management contracts to geographically diversify their presence in unexplored markets on an asset-light basis. With healthy accruals and equity infusion in one of the listed companies, the net debt for ICRA's sample set reduced by around 800 crore in FY 2022. Coupled with strong EBITDA levels, this resulted in a sharp improvement in interest coverage ratio to 6.1 times and net debt by EBITDA to 0.6 times in FY 2022. Despite ongoing capex, which could be partially debt funded, the debt metrics will remain strong going forward, backed by robust accruals and overall minimal reliance on debt. This slide summarizes our outlook on the hospital industry. ICRA's outlook remains stable as we expect the industry to continue to demonstrate healthy revenue growth and margins coupled with strong debt metrics. Some of the key risks to our assumptions include price caps. Currently, there are price caps on cardiac stents, knee implants, and some pharmaceutical products, which has impacted the margins of industry players. Any such additional regulatory measures pertaining to price caps or tax implications could pose risk to our assumptions. Next is any higher than expected debt-funded capex or acquisitions, which can result in deterioration in credit metrics. Any future pandemic or epidemic outbreak. Any further restrictions on international travel that will impact medical tourism. Deficit in availability of healthcare personnel. And relatively high inflationary pressure or delay in ramp-up of new center operations. Moving on to our last section on ICRA ratings for the industry. ICRA rates a total of 31 entities in the hospital industry, and 81% of them are in the investment grade. ICRA upgraded 7 entities in FY 2022 and 2 in year-to-date FY 2023 on the back of expectations of continued improvement in operational and financial performance, and also equity infusion in certain companies, which resulted in significant deleveraging and improvement in credit metrics. There were no downgrades in FY 2022, while rating for 2 entities were downgraded in year-to-date FY 2023. One entity was downgraded on account of weaker than expected operating and financial performance, while another entity was downgraded due to sustained deterioration in cost structure and expected decline in operating margins. With this, we end our presentation, and I will hand over to Mr. Shamsher Diwan for a panel discussion.
Thank you, Maitri, for a very comprehensive presentation. Now, before we get questions from our participants on the Q&A chat box, let me start our discussion with our guest speakers, Mr. Shetty and Dr. Tucker. Mr. Shetty, if I can come to you first, sir. COVID-19 was an unprecedented situation for the entire economy, and hospital or overall healthcare sector also was at the forefront of managing the pandemic and the impact of it, and helping vast population across the world. Now, what have been the key learnings for the sector from the pandemic, and certain aspects that you think will continue with us over the medium to longer term from the pandemic?
Yeah. You're able to hear me okay, right?
Yes, so we can hear you.
I think the biggest learning from the pandemic is something that obviously we had known being in a resource constrained environment like India, which is how unprepared we are for anything. Even before the pandemic, our healthcare system was not prepared to deal with the challenges of non-communicable diseases. And all it took was one global level pandemic to show how unprepared we are even for communicable diseases. So it's simply inadequate. But those are macro issues. Those are something that can be solved only as a country through policy, through large numbers of people working together. And this is a problem that will get solved over decades with a lot of strengthening of the health systems, improving the economy, training more doctors, nurses, and so on. But if I were to bring it down to the unit of our hospitals, our biggest learnings are that our systems as they are too highly dependent on one kind of business, which is people travel, visit a hospital, see a doctor physically, get a bunch of tests done. Sometimes the test indicate that some procedure is required, do the procedure, and then leave. And all of that presupposes that people have the ability and means to come to a hospital, which you cannot take for granted. So the lockdown was a perfect example where you literally could not leave your house. And so how do you deliver healthcare to people who cannot reach you? Now, this is actually a problem because in the country, not everyone stays in the major cities where all the hospitals are. Most of them live in the villages or far away in small towns. And there are solutions available. There's WhatsApp chat, there's Zoom, there's this very thing that we're doing right now. But the assumption that people are willing and able to want to do it and to trust. And so our biggest lesson is that the fundamental assumption that healthcare should be delivered only in hospitals has to change. And so we had to make a lot of investments in getting our doctors all enabled with video consulting devices, working with our patients to get their records beforehand, working within the hospital to improve some simple things like putting appointments and queuing. Now, why that was important was because we had to maintain social distancing during the pandemic. We couldn't have big crowds. But when we started doing appointments and system, we realized actually this is quite relevant even outside of a pandemic. So there are a lot of systemic changes that were done in the pandemic time, which are quite relevant for building a 21st century organization, which in healthcare industry means challenging a lot of assumptions, investing a lot in digitization, putting a lot in process change, which can improve operation on the margin. But of course, the larger question is still, we're woefully underprepared for the next pandemic, and even for the current challenges that all hospitals face, which is lack of doctors, lack of nurses, and huge number of patients. There's still a lot that needs to be done, but we'll get there eventually.
Sure. So I think this is one trend which even Maitri in her presentation alluded that, certain ancillary streams have come up post-COVID. And you also mentioned about teleconsultation or video consultation and home care, becoming the norm. So, Dr. Tucker, would you like to share your views? And as an analyst, I am very curious to know that, are we still seeing a large proportion or a sizable proportion of our, OPDs or consultations still happening through the alternate means as they were earlier?
Well, I think there's definitely a role for remote healthcare or home healthcare or e-healthcare, whichever way we look at it. But for a large part of tertiary care problems or serious health problems, unfortunately, there is no substitute to a physical visit, a physical exam, and doing what needs to be done. So yes, we do have a little bit of residual telehealth going on, but as far as we see it, most of it has transformed back into physical. Some of it is behavioral, some of it is cultural. So, for example, some follow-ups which could be done on a tele, where a physical consult is not really necessary. But we see that culturally, a lot of people in the communities that we serve still prefer, seeing the doctor face to face across the table and getting that exam. So, yes, we much more than before, much more than 3 years before, there is competencies developed in telehealth and home health. but I don't think they are at that level which they were during the lockdown.
Just a follow up on this, like, do you think over the medium term, investments in technology by healthcare companies, digitization, and other alternate means, do you think this will become a differentiating factor between one healthcare provider and another?
So I don't know. The way I look at it, I think there is space for multiple people to do multiple things, and you will probably have to decide if your expertise is going to be in one or the other, or do you want to ride all the horses and do everything. In my view, the competencies required to deliver physical critical healthcare are quite different from the competencies required to run a telehealth solution. So I don't think that the telehealth guys are disappearing anywhere, and I don't think hospitals are disappearing anywhere. But my view, and of whatever we have spoken to a lot of other healthcare providers, is that we believe that the existing healthcare providers, hospital groups, for the most part, don't have the kind of agility and the tech expertise or to really scale on the e-platforms as some of the other guys do. So I think, as far as we are concerned, we want to keep on doing what we are doing, what we are good at, that is delivering physical healthcare. And E would not really be a differentiator, but just one of the other facilities.
So basically what you're saying is that both will continue to find coexistence in the overall ecosystem going forward as well. Okay. Mr. Shetty, if I can come to you and maybe extend the first question. Some of the hospital chains, we've observed that they're also expanding their presence in other adjacent lines, such as ramping up their diagnostic and imaging services, even pharmacy for that matter. What would be your view from an industry standpoint, and how do you look at it?
So, hard to comment on the strategy of other hospital groups, but I look at it from our perspective. This goes back to the similar theme, what I said, that too much of our business presupposes that everyone comes to one central location to get a lot of the things done. Now, as a choice, we stayed away from building a retail presence across the cities where we participate in running hospitals, because the financials of running retail business is very different from running conventional hospitals, and it was quite unfavorable. India has some of the highest rents in the world relative to the earning capacity, and very few clinics that we run break even, and even those that break even really don't generate enough footfalls or earning to justify. But during the pandemic, and maybe a little even after that, we saw the value that it provides. One is that you're able to take care of the long tail of healthcare services for patients who've already been discharged from a hospital, let's say. So there are follow-up appointments. There are very quick interactions people need to have, picking up tests, giving blood reports, getting a scan done once in a while, which don't necessarily require to come, because the hospital is a busy place. And we'd rather they not come here and waste their time rather than doing somewhere else. So the choice remains for an organization to let someone else take that slack, or to say that we will participate in that business. And so from our perspective, the involvement of retail, lab, home care, and out of hospital services, as we call it, we are right now building those capabilities within the zone of influence for all our hospitals. So say a 15-kilometer radius around our hospital, we'll add the services so that patients who come to the hospital once don't need to keep coming for every little thing. Now, whether it can be built as a separate vertical, like a lot of other healthcare groups have, that is betting on the much larger macro healthcare scenario, which is this sector will organize, those running those businesses will get more viable with time, and they can succeed as standalone businesses. It might still, it's too early for us to take a position on this one way or another, but our take is that it is valuable for a hospital to have these for patient convenience, not necessarily from this is going to make a lot of money or this makes a lot of financial sense to do so.
Sure. So in a way, you're talking about some kind of a evolution to hub and spoke kind of a model as well, in a way, wherein certain basic services are provided at these smaller outfits.
In a sense, like that's one way to think about it. Yes.
Sure. Maybe if I can come to you, Kinjal, now, from diversification standpoint, how do you look at these revenue streams picking up for hospital chains? While Mr. Shetty explained how they are looking at this as a strategy, but how do you view this?
So yes, Shamsher, we've witnessed several players diversifying into this B2C non-captive diagnostics and retail pharmacy business in the recent past. I think this primarily helps companies enhance their brand visibility and also helps them offer a full basket of complementary services to the customers. So given that these lines of business have synergistic benefits with the existing hospital business, there would definitely be increased revenue potential per patient and even cross-selling opportunities, which will support the growth for these industry players. So we expect that this trend should continue in the future. And obviously, one other way of looking at it could also be that the companies may want to potentially spin off these at a future date so as to unlock the value for these companies.
Dr. Tucker, if I can come to you now, I think what we've also observed, and maybe you can share your views, is that we are seeing an increasing use of pay-per-use model for some of the large medical equipment or diagnostic or imaging, equipment by industry players. Do you see this trend increasing going forward and becoming far more prominent? What would be your views on this?
So I think it's a great solution. It is a great solution predominantly in terms of improving access. So I don't think this is pay-per-use is what larger healthcare groups are looking at, because essentially it is it is expensive money. But in terms of increasing access, in terms of decentralization, like Viren was saying, everyone needs to come to one place and everyone does not live in metros. So to improve doctor entrepreneurship or to improve penetration into non-metro tier 3 and beyond kind of markets, I think this kind of really provides an opportunity for new entrants into healthcare to get that confidence and make an investment into providing those services. So I think it's a great opportunity in that respect. But as far as organized healthcare players are concerned, I think it is just expensive money which most people will not be looking at.
Moving to the next agenda for our discussion today is on the outlook for the sector. Now, in her presentation, Maitri pointed out that the sector has really bounced back quite sharply from the impact of COVID, thanks to the recovery in elective surgeries. Medical tourism seems to be coming back. The payer mix has improved, and many factors have led to increase in ARPOBs and improvement in the the profitability metrics for the industry as a whole. I would just like to understand, maybe again, starting with you, Mr. Shetty, what would be your view on, from an outlook perspective? Do you agree with the kind of, outlook that ICRA is sharing, or do you see any challenges there?
Challenges, obviously, we're talking about a period of what may potentially be a worldwide recession, and healthcare expenses, while definitely it is essential in a sense, and they tend to exhibit not like the consumption basket. It's postponable. You can postpone procedures. You can postpone knee surgery, hip surgery, maybe for a few months, maybe a year or so, if you're feeling the pinch, if your income is affected. So I'm saying, taking all that out of the equation, if let's say there isn't a worldwide recession, if you assume that India is not immune, then sure, you can expect that a lot of the numbers would bounce back to where it is, because you're talking about this complete not absence, but near absence of healthcare access, absence of screening, absence of a lot of the primary care work that should have happened when 2 years people locked at home and everything was optimized for just one disease, which was mostly in the upper respiratory tract. The fact is that a lot of people didn't get their cancer screening, didn't get their checkups. And so there's a little bit of mean reversion. So we wouldn't take this as a trend that can extrapolate over the next 20 years. There's a mean reversion in place there. It could slow down. But definitely it's balanced out against people being a lot more aware about the health risks, people thinking that healthcare is more top of mind, and people being more aware that there are diseases that, the non-communicable diseases that need to be looked up. So I would say that we do see a sector that's experienced a strong rebound. A lot of industry, us as well, have planned capex, but none of this was just because of the past 2 years. A lot of the capex is pent-up demand that should have happened. It just so happened that it got postponed by 2 years, and so everyone's adding capacity online. But this will continue because we're talking about a country that one of the fastest growing in population and has the least number of beds per 10,000 people as per whatever WHO statistics says. So there's a lot of catching up to do.
Sure, that makes a lot of sense actually. Dr. Thakur, would you like to share your views on the outlook for the sector over the near to medium term? How do you see any challenges similar to what Mr. Shetty pointed out? So I think you are on mute. Sorry.
So definitely, and in the interest of time and efficiency, not repeating everything that he said, I agree with what Viren said. But I think yes, in the medium term, I see a significantly positive outlook for healthcare, predominantly, especially organized healthcare, predominantly because of a significant mindset in the community, and which has led to a very extensive penetration of the insurance. So we are seeing rapidly increasing health insurance penetration, both in metros as well as non-metros, and as a result of that, behaviorally, a lot of people, what essentially is health insurance? It is empowerment of the patient, right? So now I don't have to pay for my healthcare anymore, and if I don't have to pay for my healthcare anymore, then where do I want to go? So the south of the country, I think, already has a large share of organized healthcare, but west and central and little bit of north, I think, is still a lot of secondary care players with significant market share. So I think we are seeing a behavior change in terms of people's preferences. And health insurance seems to be a prime driver of that. So I think that is a predominant reason or predominant factor which is going to really play a good role in a positive forecast.
I just wanted to take up one specific question on ARPOBs. While we understand when we speak to many industry players, is that the industry is kind of moving away from commenting on ARPOBs, because the way I think we are delivering healthcare, things are changing. With the improvement in technology and advancement, the time spent in the hospitals has reduced. So ARPOB is perhaps it's the benefit is getting diluted. But still, for the sake of asking this question, Mr. Shetty, would you like to comment that we've seen a significant increase in ARPOBs at an aggregate level at the industry for past few years? Do you see that sustaining, or do you see some one-offs in that?
It's a multi-layered question, and given that I'm a public company, there are all sorts of forward-looking guidance I won't get into. But let me put it this way. There is the reality. There are a tremendous number of input costs that go into this business have gone up because of supply chain disruptions, because of the Chinese economy essentially shutting down its exports, because of massive worldwide problems with getting equipment where they need to be. We're looking at every single input into our hospitals increase, not 5-6% a year that we're used to. We're talking about 15, 20, 30, 50% cost escalation on the input for the drugs, the medicines, the syringe pumps, the needles, the sutures, all that we buy. 50% escalation on that. Then you're talking about these massive investments we have to make on MRIs, CTs, cath labs that are not made in India. These are all made, and actually they're not made in any one country. They're made in multiple locations all over the world. When parts come from different places and it's all assembled and charged to us in dollars or euros. And there's been the escalation of the normal price as well as the rupee depreciation in that entire time. Furthermore, India, as I mentioned earlier, with one of the costliest land anywhere in the world and the huge amount of disruptions in the construction industry, with a lot of people being sent back and coming back again, getting construction online, it costs us twice the cost to take up a new construction build than it did 4 years ago. That kind of construction escalation is unheard of. Like, I've been looking at construction for a very long time. I've never seen this much price escalation as long as I've been in this industry. Now, all of that considered, with the tremendous amount of input price escalation, it is just simply a matter of survival for healthcare groups to start adjusting their prices to reflect. Oh, and by the way, I completely forgot about wages. Because on top of all of this, you have not just minimum wage price increase, which a lot of states tend to take up as various measures to improve their popularity. You also have the fact that doctors and nurses at the senior levels getting very aggressive offers, not even from other Indian hospitals. When you're looking at entire continents worth of the healthcare sector being depopulated by either people aging out of the workforce or people taking forcible voluntary retirement in the US, Europe, Middle East, they're going to get their doctors from somewhere, and it's to us where they look to. So we have very senior, very competent people leaving the workforce, and suddenly the salary gets readjusted based on that. So looking at just as a question of basic survival for healthcare institutions across the country to readjust their prices to reflect all of that. Now, does it end up reflecting ARPOB? Yes, of course it does. But there are so many things that we're doing to make our services affordable to patients, and that is improving the efficiencies, looking at the throughput, trying to reduce the time wasted, trying to use the less expensive drugs, trying for them to, go and spend less time in the hospital. But it still cannot match up against the sheer amount of cost escalation that's happened in this industry over the past couple of years and will continue. Because what we're looking at is just the tip of the iceberg. Once every company, a multinational company, decides that their manufacturing strategy will not rely on China as a linchpin, they're going to start doing multi-locational sourcing. That drives up the cost. And who bears it? The end customer. That is us, which has to be passed on, because healthcare is just a hospital, just service industry. We're just taking our inputs and converting it to outputs. When even more people in the Western world start to realize that this healthcare business, it's not a good business to be in, we need to get out. Where they're going to replenish their supply of doctors from us. As in the Middle East and all other countries, they start strengthening the health systems, same problem. We'll have a huge amount of attrition coming from India. So you're talking about a situation where this industry will have no choice but to start relooking at the input parameters and trying to find out ways in which it is manageable for us to utilize. And also, y'all are ICRA, y'all are responsible for grading our credit rating. Regardless of the credit rating we have, the fact is we are borrowing at the MCLR plus whatever percentage you all have assigned to us, and those costs are going up, right? The RBI borrowing rate is all going up, and so that's how you end up the ARPOB increasing.
So what you're saying essentially is that a lot of the upliftment which has happened in the ARPOBs to a large extent is also driven by the fact that there has been a huge amount of inflationary headwind across the entire operations, whether it is the capital cost or the cost of simply running the operations and even manpower cost. Sure. So we have one question which has come in from someone from the guests, the speakers. For you, Dr. Thakkar, if I can ask you that Maitri's presentation talked about ROC improvement, return on capital employed, improving to double-digit terms now from what used to be subpar. Do you see this trend kind of holding up, or do you see the headwinds from a capital standpoint impacting ROC for businesses going forward?
I think going forward with especially for new projects and new greenfield expansions, with the way the inflationary problems that are being faced, and I completely agree, we are in the process of doing some new projects, and the construction and the biomedical and the MEP costs are really up 30 to 50%. And so In terms of new capex and cost per bed metrics, it is not going to be what it was 10 years back. So all the new capex is really going to be at a much heavier capex, much heavier, a lot more capital intensive. So the returns over the next 5 or 10 years will have to be tempered down a little. Having said that, opportunity point of view, yes, there are a lot of white spaces even now in India, like the slide alluded to. Compared to a lot of other countries, our beds per population is still a lot lower. A lot of them are concentrated in relatively tighter geography. So capacity utilization point of view, there is hope that we have. In terms of return on capital employed, I think the capital that is going to be employed is going to be a lot more per bed going forward. So I see a little bit of tempering there.
So I'll just take the next section also with you. About the expansion plans, as Maitri's presentation pointed out, that most of the hospital chains are expanding now in adding new hospitals or expanding at the current sites. And Mr. Shetty also mentioned that there is a little bit of a pent-upness in this because during the COVID period, everything was just put on the back burner. Now, what we've seen is that a lot of the expansion is still happening by most of the chains in tier 1 and metro towns. And there are obviously some companies which are also expanding in the hinterland, where I think, as you also mentioned, that some parts of East, Central, West still have scope for expansion compared to South and North of India. So how do you see capex requirements in different parts of the country and the returns from those kind of investments, especially from a payback standpoint? When we talk to a few companies, we see that in certain locations where the footfalls are very good, competitive dynamics are not very severe, the paybacks and the break-evens are very fast at the EBITDA level or at the cash flow level. But at some locations, companies tend to struggle. So how do you look at this?
So I think healthcare is a very, very hands-on kind of a service industry, unlike hotels where it's very easy to, for say someone like a Marriott to be anywhere in the world and a general manager can manage it perfectly well. Healthcare does not really work in that fashion. So I think this is kind of a combination of multiple factors. One is the location and the need. So a good micro location, not just which city, but even location within a city. So you can talk about medical tourism and international patients. It makes for interesting listening. But the fact is that 85+% of your work is going to come from micro markets. So getting a right micro market is going to be extremely important. So some locations will naturally do better than the other. Two, as I was saying earlier, is the focus. If you look at most of the healthcare groups across the country, and you try to analyze unit-wise performance, you will see that not all units perform the same. And if you dissect that and analyze it a little better, I think for the most part, what is common is wherever there is a leadership focus and wherever there is a better, more hands-on, more focused leadership interest, those units outperform the others. And finally, the payer side of things also contributes quite a lot in location selection, because as I said earlier, insurance is becoming more and more powerful. And if you look at capex point of view, besides the land which you buy, everything else in a healthcare project is the same, no matter where you are. In Tripura or Nepean Road, Malabaril, wherever, the cost of putting up a project is going to be the same. But from the payer side, the insurance companies currently tend to grade cities and not facilities. So what they would do is, if you are in a tier 3 with an identical facility of a metro, your reimbursements would be tempered down to a great extent. So that is one of the other factors which kind of leads one to wonder that where should your next capex be, and that is one of the other factors which is contributing to more and more centralization and concentration of expansion within larger geographies.
Sure. In fact, that's one of the questions which has come in from the audience, that do you see a clear trend in terms of capex per bed between, let's say, tier 1s, metros, and tier 2 or tier 3 cities, or as you said, there is not too much of a differentiation?
I mean, except for the land cost. Now, few metros, the land cost will be prohibitive or extremely large. But apart from those few select areas, everywhere else, the land cost maybe 5, 10, 15, 20, 50 crores here or there in terms of land. But what else is going to be different? Your entire technology is going to be the same. The cost of construction is the same. Your engineers need to pay the same for plywood and electricity, light fixtures and MRI machines and medical gas pipelines and OTs and everything. So what is the difference? The only difference is land.
Right.
I think the capex is pretty much same everywhere.
Okay. Mr. Shetty, if I can come to you on this capacity expansion plans and how you look at locations and various other elements to decide on your new investments. Do you have certain checklist or red flags in your mind that you would look at while deciding not to go ahead with certain investments?
To address a little bit of the question you raised earlier on the ROCE.
Yeah.
Even before COVID happened and before this massive cost escalation we faced, the 10-year return on capital on average, on the average hospital we were building and that we had noticed across the industry, the 10-year return on capital was not greater than the cost of capital.
Okay.
I mean, you're taking your money and putting it in the bank on a 10-year horizon. Post that, fine. But the fact is, none of us are borrowing at anything less than 7 years. I mean, most banks will not lend to us for more than 7 years. Forget about 10, 15, 20-year borrowing that a lot of the infrastructure companies are able to borrow at, or any of the low interest rate loans that they have access to. So while everyone likes to call healthcare as infrastructure, they're not treated as such. Anyway, putting that point aside, what happens is that starts guiding your investment decisions. Obviously, I can't eat my ROCE. I can't pay for my doctors and my vendors in ROCE, and no patient chooses a hospital based on return on capital. But the fact is, it is a determinant for how long you're able to stay in business. Now, if you throw that to the wind, you can expand massively. Tier 1, Tier 2, Tier 3, you can go all over the place. And eventually your bills will run up to catch up with you because you get to be in an unsustainable debt spiral. And that happened. It happened to a lot of industries. It happened to us as well, where we had uncomfortable borrowing amounts. And then we had to go to the equity markets. But it's not that equity is free money, the way a lot of startups seem to believe. Equity is the most expensive form of debt. And they have a much higher return threshold that you're going to have to hit. And so even that is not a more convenient form of looking at it. So it starts guiding our CapEx decisions. And so the way you asked earlier, why Tier 1 versus Tier 2, as Ankit said, of course, not only on the CapEx side, even on the OpEx side, it doesn't cost you any less to run a hospital in a Tier 2 town. The salaries are the same, if not more. Because a lot of the time the doctors are taking it as a, not hardship allowance per se, but whatever the more politically correct version of that, of saying that. Because they'd much rather be in a large town, have access to a larger community, have malls, have good schools. You make them go to a small town, you're going to have to pay for the difference, or you're going to have to accept someone who's not as experienced, doesn't have as much skill, taking the salary of a Tier 1 doctor. And so the OpEx is the same, if not higher. And so that means your return ratios in Tier 2, Tier 3 towns just look abysmal if we're paying for everything out of pocket. And so that guides essentially a lot of the CapEx decisions that hospitals make. So how are we looking at it? Definitely, while ROCE is a guidance, like I said, I can't eat ROCE. We still have to grow. We still have to cater to the sheer number of patients. And we have to believe that tomorrow things may get better or things will get better, where borrowing costs could come down. The healthcare inflation should moderate. the ability for insurance penetration increase and for people to be able to pay more for healthcare should go up. That people will start demanding quality and be willing to pay for that quality. If we have to believe in such things, and I certainly do, and I hope that gets borne out by the evidence, you have to grow and expand, but constrained also against this other massive wall that a lot of these projects don't pay for themselves. And so the way we're looking at CapEx is expanding within our existing network, because there are hospitals, they have significant reinvestment requirements. A hospital is not a static entity. You don't build 100 beds and then just leave it there and become 100 beds for eternity. A 100-bed hospital gets filled up in no time in this country. Then you need to expand. Not only do you need to add beds, you need to add capabilities. Today, you may have a general surgery department. Tomorrow, they'll want to be a general surgery with onco surgery. Day after, they'll want to have robotic surgery. Same department, same team, growing in capabilities, and you have to cater to their aspirations. If you're starting with normal medical oncology, you'll have to get into radiation oncology, or you have to get into bone marrow transplants, you'll have to get into immune therapy, you have to start doing research. All of this costs a tremendous amount of money. And so that's essentially a lot of the investment guided through the hospital that we have, making them larger, making them more efficient, investing a huge amount in IT, and improving the processes that these hospitals work under, just in the hope that we're able to meet the patients where they are, cater to the requirements, while also keeping in mind that we have a very punishing capital return environment where we're borrowing at very high interest rates. We have to pay it back. If we don't, we all lose our companies.
Very interesting to know, sir, when you said that, on a 10-year horizon, the average ROC was just about close to the cost of capital. I think that's a very important point that you made. Now, taking this, discussion forward to our last section of the discussion point is that, what kind of reforms or policy measures would you like to see, not just from the coming budget maybe, but over the medium term, which can help ease out all these challenges that the healthcare sector faces?
I would say on the cost of capital, that's primarily a question of borrowing, either long tenure debt, being able to borrow at the MCLR, being able to borrow from foreign sources, maybe not dollar denominated, because that exposes us to interest rate, the forex risk, but FX risk, but just being able to access bond markets that can lend to us at 15 years at a very low interest rate. So cost of capital is a major hindrance. Cost of infrastructure, it is what it is. I don't imagine any scenario in which our cities will suddenly have very good zoning regulation and will actually enforce the rules that were put in place when the country was founded, that certain areas have to be allocated for healthcare systems and those can be used only for that purpose. Whereas what you have right now, land use is rather fluid. And so a person with access to land zoned for healthcare is pricing it as at a commercial build or a residential, any other sort of build. And so we end up being punished by paying for what can generate much more return, but you're paying that much more for land. So upfront cost, at least within the realms that can be contained, I would say that if some amount of enforcement of zoning regulation can happen, that could, it unlikely to happen, but if it can go in that direction. We can't control a lot of the other input costs. The medical equipment will still be a long way away from being manufactured here. On medicines, I think India has done a great job. At least on medicine cost, it's not so bad. And now with a lot of the APIs coming into India and API manufacturing being encouraged, a lot of the precursor elements for a lot of the drugs that we use, the price, I doubt it will come down because it's still much cheaper to get these things done in China, but at least it won't increase and may not be as many supply disruptions. The other major cost for us is manpower inflation. So anything that can be done to liberalize medical education, to reduce the requirements. I mean, this day and age, to ask for 35 acres of land to build a medical college is ridiculous. It's expensive to do so. And it constrains how many medical colleges can be set up. And the fact is, we're not just training doctors for India, we're training doctors for the whole world, because the whole world is poaching our talent. So it doesn't matter. It doesn't cost you that much to build a college. There are engineering colleges all over the South producing a surplus. And so that's why you have the entire Silicon Valley being dominated by people from our country. There's no reason, and in healthcare, it's pretty much the same, but we can do that times 10. You can 10x the number of doctors that are being produced this year. If you liberalize that and create lower entry requirements, allow not just non-profits, but allow for-profits to get into medical education, you can train a large number of doctors and nurses. and that will address a lot of the manpower issues. That is another big hurdle towards being able to set up hospitals in small towns. The fact is, no one wants to work there. The only reason you'll end up in a small town is if there are no jobs for you in the big town. But as long as there's an artificial constraint on the number of doctors that get produced, the big towns will always be the ones to suck up the most amount of talent, and small towns struggle as a result.
Just 2 points, sir. Dr. Thakur, would you agree with everything else? I mean, do you think there's something more that can be done as well besides lowering down the cost of capital, providing long-term sources of funding, bringing down the capex through land reforms, as Mr. Shetty said, and other things?
Well, I think as a business entity, there are always a laundry list of desires from the government, and we can keep talking about it till the cows come home. But I agree with everything that is being said. People have been talking about all of these, and taxation, and no inputs in healthcare, and all those kind of things. I think if you have chosen to live in this country and you have chosen to work in healthcare within India, we must understand the regulatory framework today, the landscape today, and if we agree with that, let's go ahead and do this. But I don't have a big hope or a big aspiration for too many regulatory reforms. I think if they happen, great. If they don't, we'll have to figure out how to work in the cards that we have been dealt with, and move on. So.
Okay. Thanks a lot, sir, for your input. So, in the interest of time, maybe we'll now, close our discussion, and I'll hand over to Kinjal for her closing remarks. And once again, thank you, sir, for taking out time from your busy schedule to join our webinar. Over to you, Kinjal.
Yeah, thanks, Shamsher. We would like to thank both our guests for taking out time and engaging in such an insightful discussion. We would also like to thank all the attendees for joining us today. Do keep checking our research websites for updates on the sector, and reach out to us in case you have any questions or clarifications. Thank you all.
Thank you. Thank you, sir.
Thank you.